of my continuing series all about the markets. Today we're going to talk about derivatives. I know for some people it can be a very scary term. And this is going to be just a basic, simple overview of derivatives. What are they? How do they work? What types are there? I'm going to mainly focus in this discussion about two types of derivatives: futures and options. And probably the other one that you've heard of due to the financial crisis is mortgage-backed securities. All these things have one thing in common. They derive their price from an underlying instrument or asset. So let's dive in and we'll briefly discuss what futures are. Futures are contracts to pay for a commodity at a certain price at a certain time in the future. What are commodities? Because commodities aren't futures, and futures could be commodities, or a derivative of commodities. So here's the difference. Commodities are your hard assets like gold, silver, oil, cattle, wheat, coffee, cocoa, sugar, and then you have other assets, what I call soft assets: bond futures, stock index futures, single stock futures, currency futures. So futures can encompass a big chunk of the market. Well, what are they used for? Well, they're used for a hedge. Okay? So let's just say, for example, I'm an airline company. And I see the price of oil in the future, about 2 years ahead, is $25 a barrel. Okay? Currently, oil is trading at $60 a barrel. Wow. How much cheaper is that? What I would do is go buy a futures contract now, 2 years ahead, to offset the cost of my jet fuel. And if I'm not mistaken, they probably do have jet fuel futures contracts. So this helps the airline mitigate some of the cost of rising fuel costs. What they would do in this case, because the price of the futures contract is so cheap, they would hold on to it until expiration. Either they would take it, which I see no reason why they would, because that means you have to take delivery of the said commodity, or they would sell it. Now, hopefully by this stage, 2 years later, the cost of the future contract has gone up enough to mitigate the cost in rising jet fuel to an extent. It's not going to be perfect, but it helps offset the cost. So futures are useful for farmers to know their cost of their crops, cattle farmers for their for the cattle, poultry farmers, pork farmers. They all have contracts. Like one guy said, who used to work in the Chicago Mercantile Exchange, said, he goes, "You know that Big Mac you just ate?" He goes, "I bet you I traded that cattle contract about 2,000 times today." It's very, very interesting how it all comes together. It's very unique. Futures, however, are not without their risks. Because they are so expensive, and I'll get into that in a second, you have to buy a contract, okay? I got into a debate with a family member of mine who said he wanted to buy 1 barrel of oil. You just can't buy 1 barrel of oil. In order to fulfill the West Texas Intermediate crude, to buy a future, you got to buy 5,000 barrels of oil. Okay. So let's take the S&P 500 for example. It closed at 2260, I believe. Let me just double check that for you. And okay, let's just use 2260 for round number's sake. So that is the closing price of the S&P 500 index. Now, for the futures contract, we have to multiply that number by 250. All right, so this is a nice round number. To buy one contract of the S&P future, it's going to cost you $565,000. Now you may think, "Oh my God, what do I do?" Well, there's a couple of things you could do if you want to get into this aspect of investing. The single most important thing you do is you buy on margin. Okay, excuse me about that. You buy on margin. What's margin? Margin, much like with equity or stock investing, is buying on credit. Okay? Now, unlike the stock market or the equity markets, the margin is not set by the Federal Reserve, which for equity investors, you'll know to margin stock, you got to get what's called a Reg T or a Regulation T account, which then enables the broker to cover 50% of the security on margin. So let's just say, and I'm backtracking a little bit here, but you have 100 shares of Disney at $100. Okay, that would be what? $100,000 worth. Well, let's say you only have $50,000 to spend. You open up a Reg T margin account, okay, and the broker will say, "Okay, I'll give you $50,000 on credit. You put in the other $50,000, and we're golden." That's not without risk, though. Much like as an equity investor, this is where this comes into play, because for a futures trade, the exchanges set the margin rates. I think it's quarterly, depending on market conditions, to mitigate their risk. So I know some futures contracts are up in the 70% range that you have to put up and only give you 30. And now this is where they're both similar. So let's say the account drops below 10% of its value. Well, that's your maintenance level. So that's where you got to put more money in to keep the account going. Otherwise, in both circumstances, the accounts will be liquidated by what's called a margin call, as we used to say in the business. That's what brought on the stock market crash in 1929. Right there is margin calls. Excuse me. People who got exuberant about purchasing stock on margin because it was cheaper. Well, as the market started to precipitously drop, these accounts started to slowly dribble down. And as they reached their maintenance level, margin calls started coming in. And people could not refund the accounts, shall we say, and build them up again to above maintenance level to keep it going. So what do? You sell a forced sale, a forced sale, a forced sale, and it creates this domino effect, and prices just collapsed. So that's the risk with futures trading as well, that you have to get it on margin because it's just not attainable for everybody, you know. Unless you have a managed futures fund where then everything is allocated, but we're not going to go there in this topic of discussion. So futures are a very innovative tool that you can also do what's called arbitrage. All right, give you a simple description of arbitrage. Let's say you're walking down the street and you find a $1 bill and you pick it up. That's arbitrage. You just arbitrage that $1. It's found money. So, how do your institutions arbitrage? Well, let's look at the S&P 500, for example. So, you average the index and you realize that the futures contract costs 2 points more. So if it's 2260 and the S&P future is 2262, you would buy the 500 stocks and instantly sell a futures contract for the same equivalent, therefore immediately making that 2-point profit instantly. It's found money, ostensibly. Arbitrage is very useful, especially like, let's say if you have shares that trade on multiple exchanges in a company. Let's say you got Intel on the NASDAQ and you got Intel over in London, but there's a $3-4 difference in the share price for whatever reason. That's instant arbitrage, instant money, if you know how to trade it right. So that's where futures are also used from an equity perspective. You can do index arbitrage. Now, let's take a look at options. Similar, yet very different. Similar in the sense that options are also derivatives. They derive their price from indices and equities. Okay. Also futures. There's also futures options. So there's just this multitude of different scenarios that you can use to help your portfolio. Options are, simply put, instruments that give you the right, but not the obligation, to buy or sell a specific security at a specific price at a specific date and time in the future. There are two forms of options: calls and puts. Now, if you guys remember back in the day, seeing those traders going crazy, well, what does that mean? Well, palm out or palm in towards you, you're calling it in. You're buying. You're bringing it into you, right? You're calling it in. That's a call. Palm out, away, you're putting it out, selling it. Okay, and then they'd go through their sizes: 1, 2, 3, 4, 6, 7, 8, 9, 10. There's just different ways the hand signals work, which I do have literature on. And if you're so interested, I can send it off to you. It's really, really cool. It's cool stuff. Now, as options, like I said, they give you the right, but not the obligation, to purchase a specific security at a specific time, a specific price, and a specific quantity. Typically, it's 100 shares or a round lot. Okay? So, let's say I have 100 shares of Apple at $100 in my portfolio. I don't necessarily want to sell it, but I think it's going to go down. What I would do to protect that position is I would buy some puts. Okay, and so as the price of the stock were to drop, the value of the put would increase, offsetting some of that loss. It may be a complete offset, it may not be, depending on how you set it up. So this is why I recommend you guys talk to your financial advisors, someone who's an expert in these things, to help you better understand this stuff. Again, this is just a basic discussion, okay? So, okay, well, how much do I pay for an option? It depends. Is it an at-the-money put? Out-of-the-money put? These are things that I can segue into later in more detail, discussing these terms. I do recommend there is a book that you can get, the Barron's Dictionary of Financial and Investment Terms, could certainly help you. But now, this is an interesting thing. So let's look at the Apple example. 100 shares for $100. If I look at a strike price of an option, 100, that's a strike price. Okay. But the premium is only $2. I can control that same 100 shares for $2 instead of $100 a share. That's the sweet part. That's called leverage. That's how you lever yourself. Okay. Listen, this is a very risky topic because it is a high-speed market. Okay. And I strongly suggest you do your research. This is basic terminology, it's basic information to help you point you in the right direction. I can expound on this further if you would like me to do so. Let me know in the comments below. I'll provide you with more information as deemed necessary, but I want you guys at least to understand, to hear the terms: options, calls, puts, at the money, out of the money. Also, you have intrinsic value to worry about. You have time value of money to worry about. You got your delta, your beta, your gamma, your theta. Those are the Greeks. You got to worry about those. All have to do with velocity. All have to do with pricing. Stuff that I'm not going to get into, but there are terms that are out there. And the more you know, the more knowledge you have, the better you can make your portfolios. These are all tools that are out there for you to help you. So, that said, just a brief overview about derivatives. I definitely encourage you to research, and if you found something in error, I want to know. If you're not sure about something, please ask. I always invite you. I want to learn from you, and I want you to learn from me. I do think that later on in the series I'm going to focus on some more advanced topics with options. So this is just a basic, tutorial. I want to stress that is, about them. What are they? What are the terms? How do they work? So with that, being that it is December 23rd, I want to wish you all a wonderful Christmas season. Have a joyous Christmas with your family and friends. And I will see you guys next week. Thank you very much. I'll talk to you later. Bye-bye.